Today I'm going to be rating this guy's Forex trades. His name's Daniel. He's in my group where people can ask me anything. They can follow my trades in real time, and they can do live trading sessions with me every single morning. I also post all the analysis for these trades for free in my free Telegram channel. So if you're wondering what I'm actually doing, the trades I'm taking, the analysis I'm doing, I just post it all for free and have done so for the past 7 years in the Mission FX trading channel. If you're new to my channel, my name's Nick. I've been trading Forex and crypto and stocks for almost a decade. I've made millions of dollars, and in this video, we're going to be looking at Daniel's Forex trades. So Daniel's one of my clients, and he posted this yesterday in our group chat here. He asked, "Hey Nick, I took these trades as a break and retest trade on Euro USD, and I would have gotten out, but when it started consolidating. But here's my questions." He asked me, was my stop loss too big, and how would you have managed this trade? Also, would you close it when it started consolidating? Now, let's actually go and look at this trade. I've already got it pulled up on TradingView. So I'm going to go here to TradingView, and you can see this is the trade that Daniel took right here. So what did Daniel do? He essentially just found this little support resistance zone right here where these highs are. He waited for price to break above it. Then when it came back, he bought. He had a stop loss underneath the zone, somewhere like that, and then a target somewhere up here. And we'll go actually capture his exact stop loss and profit target. So it looks like, it looks like his stop was just under the lows. So one of Daniel's first questions was the stop loss too big? Was there anything wrong with the stop loss? In my experience, the stop loss just has to go past the zone that you're entering off of. So think of it this way. Support resistance, it has zero predictive power. Support resistance is just a technical analysis tool that helps you structure risk so that in trading, you have a way to statistically make a little bit more money than you lose long term, given you have enough experience and just a slight edge. What is this edge? Perhaps you're just using a 1-to-1 risk-reward ratio and your win rate is slightly above 50%. If you have a 55 to 60% win rate, net of fees and commissions and swaps and spreads and things like that, you do have a profitable trading approach. It is just objective reality that if you can win a little more than half the time with the 1-to-1 risk-reward ratio, that you can make a consistent profit in trading. Now, this is way easier said than done. Trading is risky and most people lose money, and almost everyone fails at trading because they don't structure risk. I'm going to show you how to structure risk with support resistance. So let's look at this. How would I have structured risk if I were taking a trade here? I wouldn't have taken this trade, but again, that's just me, and there's nothing wrong with this trade that Daniel took. All we're doing is we're looking at the mechanics here. So whenever you have a support resistance zone, all price has to do, price has to show it's been a clear support resistance zone, whether you're on the minute 5 chart, the 15-minute chart, the hour chart, the daily chart, the weekly chart, the monthly chart, the yearly chart, or the decadely chart. You just have to identify an area where price has clearly bounced out a couple times and seems to be respecting pretty well as support resistance. Now, of course, this is subjective. Of course, there's no black and white rules. Of course, it's going to require you to give 2% of a shit and get some experience to start seeing what works and what doesn't. But in general, the basis of support resistance relies around the fact that it has to be an area that's very clear. Has to be an area that you can look at the chart and say, very obviously, price has bounced out a couple times. So when price breaks above a zone and comes back to test it, here's essentially how I structure most of my trades. I'll put an entry at the zone, and then I'll just put a stop just past the zone. Now, the idea here is that if you put the stop too close, price can pin a little bit below the zone, but technically still be valid and then just fake out and come back up, and I don't want to get stopped out if that occurs. If you put your stop loss really far below the zone and the recent low and the previous low before that, and perhaps even the previous low before that, you're just putting the stop loss way too far, and it's just unnecessary, because if price breaks past that zone, the technical analysis and the idea of support resistance suggests that if price breaks there, your trading idea is invalidated. It'd probably be better to get out for that time period and that trade, and then just wait for the next trading opportunity and then take another trade. And again, if you just win a little more than half the trades with a 1-to-1 risk-reward ratio, and you're risking the same amount per trade, and fees and commissions and swaps and everything aren't eating into too many of your profits, then you have a statistically profitable system long term. Just have to win a little more than half the time. So in this case, the trade would have to look something like that to get at least a 1-to-1. It's just unnecessary. So where would I put the stop loss here? Not too close, not too far, just below the zone. Enough below the zone where if price spikes a little bit below it, and the zone ends up being a little bit thicker than you thought it was originally, you're not going to get stopped out. Target, usually I put it just a 1-to-1. Sometimes I'll let my winners run a little bit further, sometimes 1 to 1.5, 1 to 2, but I always structure the risk just based on 1-to-1 risk reward ratio, just because if you have a 1-to-1 risk reward ratio, you'll be winning all the time and losing all the time. the trade duration is much quicker, and the amount of mental gymnastics you have to do to justify staying in a trade or taking a trade is much less. It's way easier to have a 1-to-1 risk reward ratio, especially when you're learning, because then you can see the win rate. It's going to be 50% long term given enough trades. If you just randomly enter random trades and just put a 1-to-1 risk reward ratio and risk the same dollar amount per trade, you will have about a 50% win rate. Maybe it'll be 48-52. Maybe it'll be 49-51. But it's going to be roughly 50-50 net of fees and commissions, of course. Like, you have to consider that as well. But if you can get a 1-to-1 risk reward ratio and get your win rate up to like 55, 60, 65%, then you have a profitable system. And then now you're winning all the time and losing all the time, but you make a little bit more than you lose. And when you start risking higher dollar amounts, the profits can get absolutely absurd. Say you're risking $10,000 per trade, and you take a bunch of trades throughout the month, and you only come out on top 4 units of profit, 4 units of risk. You've made $40,000 for that trading month. I have months where I make $50,000 trading, and I have months where I lose $50,000 trading. The only thing that's true is that I make a little bit more than I lose long term, and you can do the same thing. That's all that matters. You just have to get some experience. So in structuring trades like this, how would I have structured Daniel's trade? Well, for one, I probably wouldn't have used this zone right here. I like to generally use zones that are a little bit more clear and have a little bit more price action painted at them, just because there tends to be bigger moves off of them. So for this right here, price spiking around back and forth, and then also this low bouncing here, that high bouncing there is resistance, this support. This just seems to be kind of a sloppy zone to me. So I instead of using a zone like this, I would use a zone where price seems to have bounced more reliably, which would probably be this resistance zone here. You will also see, based on the higher time frame, I have a bigger support zone here. But again, Daniel was trading on the lower time frame. That's fine. I'm also going to click to the 1 hour chart because I think this will be a little bit more clear. And what I would have done is just simply waited for price to break above this zone. And if that happened, whenever it come back to retest it, I would essentially wait to see if price looked like it was going to start bouncing. And then if price looked like it would start bouncing there, I would enter a trade, and I would make sure that my entry happens to be somewhere in the zone. If it already bounces and it's already outside the zone, I generally will not take a trade. But if I'm able to see some sort of a rejection candle or indecision candle, just some type of Wagyu beef, bullish, institutional, Kobe steak, medium rare candlestick, entry, bullish strategy, candlestick pattern, then I'll just enter a trade at the zone after I think price is kind of pausing and looks like it's going to start turning back to the upside. And then I will buy. I will structure my risk with a stop loss just below the zone, and then I'll set the target, at least initially, at 1-to-1 risk reward ratio. And of course, I can manage it as it starts to play out. That's how I would have structured a trade. Now, let's just say I would have taken the exact trade as Daniel. What we'll do is I'll show you how I would have structured this, and then I'll also show you how he did it. So Daniel structured the trade essentially like this. He waited for price to come back to the zone. I know he started his trading view long tool right here. I'm assuming that was just an oversight on him, but I'm assuming he waited for it to break out and then come all the way back, and then he entered there. He put a stop loss roughly in this area, like just past these recent lows. Then he put his target, I assume, at a 1-to-1 risk reward ratio. So price came back. There's not really anything that I would have done different aside from the placement of the stop loss. I think that it would have been much more reasonable to just put a stop loss below the zone here and have a target at a 1-to-1 risk reward ratio. The problem with this is that when you're using time frames like 1 minute, 5 minute, 15 minute, even sometimes on 30 minute and hour, you end up using zones that don't have a lot of clear relevance, right? You end up using zones where you're like, okay, you have to zoom way in. You have to ask yourself, is that the actual zone right there? And if that's the actual zone, can my stop loss go right there? Or should I make it a little bit wider? Or I got to also encapsulate that high right there. So maybe the zone looks like this, and then you just have no clue. When it's stuff like this, I just tend to disregard the zone. It's not worth it. What's more worth it is trading zones that have way more like big price action at them. So like areas where prices come and had a nice bounce off of. In this case, prices bounced 45 pips off this zone. It did the same thing again right after that. And then it broke below, then it came back and retested. When you're using zones like this that are just a little bit more relevant, a little bit thicker, have a little bit more price action painted at them, you can structure trades so much easier with support resistance. Price breaks below, comes back, hits the zone, starts to reject. So you get an entry right there. Your stop loss just has to be above the zone. And again, you don't want it too close because, like, say if it was that close, the spread will go out. And just without even price getting to that invalidation stop loss area, the spread will throw you out of the trade. And that's so annoying, it's not worth doing. But you also don't need to have it way the hell up here, past the zone, past the recent high, past the next support resistance zone. Like, it's just not necessary, right? Your trade duration is going to be way longer. You're going to be way more frustrated sitting in trades that go almost to the target, but then come back. And if you're going to trade for like a month, that stuff like that is just very annoying if you're trading on like the 1 hour time frame. Putting a stop just above the zone, not too close, not too far, is generally a good idea, in my opinion. Not financial advice. Do whatever the hell you want. I'm just telling you what I do. And then just setting a one-to-one take profit, at least initially, to just structure the risk for the trade. Set the one-to-one profit target, and then you can enter. So if that plays out, then you'll make a profit. And if it doesn't play out, then you'll lose. Now, this leads into Daniel's second question. How would you have managed this trade? So unfortunately for Daniel, this trade, again, I'm assuming he entered whenever price broke above and then came back. He shows the TradingView thing start right here, which almost looks like it was like he was like buying on a breakout. I don't think that's what he did. Maybe I'm wrong, but I think he waited for it to come back, and then entered after it came back. So how would you have managed this trade? Would you close it when it started consolidating? The simple answer to this question is I don't know, just because I didn't take that trade, I didn't structure that trade, and I wasn't in that trade looking at it, watching the price action, managing it. What I will say is, in general, if I get in a trade and it doesn't start working, meaning it just starts going sideways, it just starts patching sideways, small profit, small loss, and then I reanalyze the trade and I think, okay, if price was going to bounce here, probably would have already happened. Instead, it's had like 2 or 3 little bounces, but it's not really having a big move off the zone. An example of what that price action would look like is, in the case of this Euro USD hypothetical figurative trade, came in the zone, started bouncing away, came back to the zone, tried to bounce away again. And then if it started coming back into the zone and then just doing some stuff like this where it's going sideways, making like higher lows and just going sideways, that would probably be a trade that I exit. Now, why would I exit the trade? It's based on the simple logic that when you're right, most of the trades you will win, in my very humble opinion. You enter and they just start going into profit. And they go 25, 50% of the way to the target, have a little pause, have a little retrace, grab a beer, and then they go 75% of the way to the target. Then they go and actually hit the profit target, and there's really not too much drama. The trades that typically don't work out more often than not, in my very humble experience and in my experience coaching thousands of clients, has been the case that when you enter a trade and it starts going sideways and it starts fucking around and going up and down, back and forth and drawdown, profit, sideways, spreads get wide, Asian session happens, you're paying tons of swap fees. Those kind of pain in the ass trades are the ones that generally don't result in the best outcome. Now, sure, every now and then that will happen, then price will end up running towards your profit target. And then you will tell yourself shit like, oh, I just have to be patient. I just have to wait. I just have to have the mental fortitude to, battle it out with the buyers and sellers fighting over the consolidation. I'm of the opinion that if a trade's not working and you can manage it by just closing the trade at break even or a small profit or small loss, you're essentially removing risk from the table, because it's based on the idea that if price is going to bounce at that area, price is going to get into that, in this example, resistance zone. You will sell, and then everybody else will come in and start putting sell orders, causing price to just bounce away from the zone. If price comes up into a resistance zone and then you sell, and then nobody else is selling, right? Or at least not enough selling to cause like the momentum back to the downside. What that means is there are not enough sellers at that area, because if there was, it would have already happened. Now, again, if price bounces away once and then comes back and tests a second time and then bounces away there, that's generally fine, right? But what I'm saying is context and price action suggest that if it's tried 3, 4, 5 times to bounce downward at the zone, but it's not going down and the move's not happening, it generally means there's just not enough sellers there at that exact moment, in that particular time, at that particular price, to fuel the liquidity for price to move back down. In those cases, the trade likelihood of it working out to play out in profit just becomes less, in my very humble opinion, based on my experience trading. I know it's all subjective. I know it's all just my opinion. You can get your own experience and you can see for yourself what happens. And I will just tell you that is what I have noticed is the case for me. So with this being the case, that is where I would close the trade early if it starts consolidating. And I've just kind of broken that down and given you some details. How would I manage this trade if I took it? If someone blindfolded me and said, hey, we entered this trade for you, and they took the blindfold off and said, here's the trade you're in, Nick. There would have been nothing to do to manage this. When price went down halfway to the stop loss, then started consolidating here, perhaps, I might have done something like closing the trade partially like the way to the stop loss. There was actually a trade I called this week where I exited a short position and then I actually entered a long position. And I'll show you why. So this is a trade that I called this week in the MFX Knicks Trades group. If you're not in this group, you should join it, because I just call all my live trades out. I show literally everything. I show my actual trading terminals. I call it the moment I enter this trade. I put every single thing I'm doing very simply. I don't do any trading view images of like here's the stop loss and here's this and that without showing my trading terminal. No, when I take a trade, I post a screenshot of the actual chart terminal as well as my trading terminal and P&L and equity, margin requirements, everything. I show it all here, and the full history is documented for all of last year and all of this year. MFX Nix Trades is a great place for you to join. And the reason I'm telling you this is because you can ask me anything you want at any time you want, as much as you want, inside the group chat within Nix Trades. And we actually just added it like a month or two ago. So it's very new that we're adding all this stuff. And on top of that, we do live trading sessions almost every morning around 7 a.m. Central Standard Time here in Texas, almost every weekday. Sometimes we don't do it if I got something going on, but almost every weekday we do a live session. You get to follow my trades, every single trade in real time. You get to ask me anything you want in the chat at any time, for any reason, any type of question, even if it's weird as fuck. And the third thing is you get access to all the Zoom sessions every day. It is the perfect place to learn, and it is a monthly subscription, and you can cancel at any time. If you're not in the Mission FX Nix Trades group and you're struggling, you should consider joining because you get to do stuff like this. So I closed this Euro AUD trade for one of the same reasons that I told Daniel that I would, just now, that I would close the trade if it consolidates. You can see I entered a trade up here. Price went, I'm in this sell position. Price started going into profit, but then it popped back up. Tried to go down again, popped up. Tried to go down again, made a higher low, and now started going up. So what I did is I opted to close the Euro AUD trade there in profit because I thought, okay, it doesn't look like it's going to work out anymore. Instead, I thought it was going to go up. So what did I do? I entered a buy. I put a stop loss just below the recent lows. Because if we're structuring this trade based off support resistance, I'm just going to actually show you the full analysis here in the chart. I usually don't look at anything less than the 1 hour. Start on the daily, go to the 4 hour, the 1 hour. But if you see this right here, if price is actually going to break and retest this zone, just same exact similar trade Daniel took. If it's going to work out, right, and I've entered up here, then the stop just needs to be below the recent low. So you can see exactly where I had my actual stop loss because this is my actual trading terminal. I use MetaTrader 5 mobile and Forex.com as my broker. And I use just the regular commission-free standard account with Forex.com. So this right here, you can see my stop loss is just under the lows. So it's just under, you can see there's the lows right there. And the take profit's just a 1-to-1. So, what does the trade look like? Something like this, right? 1-to-1 risk-reward ratio. Profit targets around the previous high. There's this and that. When you enter a trade, if this trade was going to go down, short, it's generally going to happen relatively quickly, right? The fact that it came down here, stopped at the previous low, then starts going up and going sideways and making higher lows, it just makes it less likely to work out for sells. It makes it less likely for price to continue to the downside, and instead it makes it more likely that price will actually turn up and go the other way. Why? It just probably means there's not enough people selling here in this region to cause price to go to the downside. Learning how to manage a trade based on your discretion and your intuition and your applied experience and your wisdom that you've gained through the years of losing money trading, that discretion and intuition is very valuable for you because that is what gives you your edge as a manual trader. There is no way you can mathematically or statistically model a profitable trading approach using objective black and white mechanical measures in the market. The market is pretty much random if you want to look at it in a scientific way. The only way you get profitable as a manual trader, and this is something you cannot even prove, you have to learn it through experience and you have to validate this statement through experience. The only way you get profitable as a manual trader is through your discretion, your intuition, that subjective feeling that you get that generates an opinion about what you think is likely to happen, and then you participate in that trading idea or opinion or trade based on literally nothing but pure feeling. And I know some people will say this is super stupid, and a lot of people who are not profitable say this because they're like, oh, you don't trade on feeling. I have trading rules and I'm profitable and Nick is full of shit. The same feelings and opinions and subjective intuition that people use to take a trading system with trading rules and then parse those criteria through their own subjective opinions, which then generates a trading opportunity, it is the same exact mechanics. You are just adding an extra layer of complexity by putting a black and white trading approach in place. This is why I don't have a black and white system. All it does is it gets you to focus on things that do not matter at the cost of things that do matter. And if I sound smug, it's because I've seen this for almost a decade. And I went through this myself for years before I finally realized that the only thing that makes a person profitable is their experience and their intuition and their discretion and the wisdom they get as a result of all this stuff combined. That is where your edge comes in. That is where you move from like winning half your trades to maybe a little more than half your trades, like 50% to 60%. That edge is very, very valuable, and part of that edge is in the way that you manage trading opportunities like this. So I'm in this trade right here. We're going to see how this works out. My trading terminal looked like this. when the market closed on Friday, and we will see how it goes. The only other trade I'm in right now is GBP CAD here in the Nix Trades group. I think this is still going to work out. Why do I think it's going to work out? I've sold up here, and I have more positions like earlier entries down here. I think I've got one like in this area, and then I've got like a second entry here, and then a third entry here at the top. This is one of those trades where, let's see if I can find it right here. Yep, GBP CAD. So you can see this is a daily chart. Prices went all the way up here and made a new high. I sold because I think price is going to come back to retest this resistance here. And then guess what? When price gets to that resistance zone, I'll be out in profit. That's just one of my positions. Will be a $20,000 profit if that hits. With the other positions combined, I think it'll be a net profit of around $38,000. So almost 40K if it works out. And guess what I'm going to do as soon as it gets there? If it gets there to this resistance zone and then starts bouncing as support, I'm going to buy. It's going to be a break and retest trade. I'm going to buy and put a stop loss just under the zone. Target at a 1-to-1. And then if I'm right on that, I'll make 10K, 20K, 30K, 40K. It just kind of depends on how much I risk and where I add and what the risk structure is for it. But that is what I'm doing. So GBP CAD is still working out. The reason I'm choosing to stay in GBP CAD is because whenever you look at the chart here, you can see that price has started to fall. And then on top of that, it's still making lower highs and lower lows. We've got a set of lower lows all throughout here. We tried to pull up, price failed to go higher, came back to the lows. I think something like this is going to happen next week where we start to see a further move down, and then either it'll get all the way back to this support resistance zone down there, or it will patch around sideways for a little bit longer and we'll just have to wait a little bit longer. But I do think that this is still likely to go down. I think the fact that we're making lower highs and lower lows on the time frames like the 1 hour means that price will start to go down. It's really not that complicated. Whenever you look at the chart, price just kind of zigzags back and forth. It just goes up and down and up and down and up and down. You don't have to do any fancy analysis. Price has just gone up. I just think it's going to go down, and I'm managing the trade in such a way that I believe is viable based on my risk structure, my risk tolerance. That's GBP CAD and Euro AUD. If you'd like to follow all these trades for free, again, you should be in the free Telegram channel. It is absolutely free, and I literally just share everything. I post all my analysis, all the stuff I'm doing, all my thoughts, my insights to the market. You get updates for all my YouTube videos. Sometimes I'll show my trading terminal, though I mainly just reserve that for people in the Nix Trades group since that's what they pay for. And I just post a bunch of other cool stuff. And I've been running this group for like, like I said, like 7 years, since the summer of 2018. So whatever time it is now, like right now it's like 7 years from then. But whenever you're watching this video, I don't know, running this group forever. So if you're not in this group, I literally show everything. Documented my like entire trading career from like a couple months after me getting profitable all the way up until now. So you should join it. It's free. If you don't like it, you can leave in like 10 seconds. You can just scroll through it, say it's bullshit, and leave. That's perfectly fine. 63,000 members are in the group at the time of this video. I hope you'll join it through the first link in the description or the pinned comment. I will see you in there, my friend. Happy trading. Bye.